Saurabh Gupta joining us now, Chief Financial Officer at Dixon Technology. Saurabh, very good morning to you. And we were just trying to figure out what the street is seeing in your numbers, because in the face of it, it's been a fantastic quarter. A beat on estimates on most earning drivers. Margins, yes, is flat. So let's start with the fabrication foray and the $3 billion that it will cost. How will you fund it? Let me start right there.
Yeah, good morning. I think so. Display fab is in line with the strategy for backward integration. You know that we have a big play in LED TVs, in mobile phones, and now going forward in IT hardware products. So the display fab will be basically used across all these three categories, and we have a large play, large volumes. So it is basically we plan to get into that, so create more strength and moat around these businesses. Yeah, so the total capex deployment, which will happen over a period of next 2.5 to 3 years, the total capex is around 2.7 to $3 billion, out of which we believe that as per the government guidelines, as per the ISM policy of the government, almost 70% will be funded both by the central and the state governments. So our outlay should be closer to $800 to $900 million, which will be done over a period of 3 years. And we also have a technology partner in place. Of course, those numbers will be worked out on clearly what is investments the partner would make, or so that is something that will be worked out over the next few months. But I feel that the company has strong internal accruals, strong earnings visibility. We still have a very low debt to equity in the company, so we can always manage to take some more debt. And also, we also have an ESOP program running. So we also are expected to get a lot of ESOP proceeds over the next 2 3 years from our stakeholders, which is the employees. So I think so. I feel confident that large part of this or a significant part of this capex can be funded over a period of 2 3 years through all this mechanism.
So, Saurabh, no plans to raise funds through equity as far as this particular capital expenditure over the next 3 years is concerned, not through equity, not through debt, right?
Yeah, so I feel that not as of now. We don't see a reason. I feel confident that it can be funded from internal accruals, because a lot of our capex on the other verticals has been done, like on mobiles, other PLI committed capexes across other verticals. So now the large part of the capex out of the earnings will go towards this only. And I feel confident that since the gestation period of the project will be like 2.5 3 years, I think so we'll have that earnings also, and to fund the capex, because that will happen gradually over that period.
So, Saurabh, the other factor I think is the mobile division. Of course, again, mobile and EMS division has seen a good year-on-year boost in terms of margins. The revenue split has seen also great growth. You have good growth coming in there. And then there's talk of maybe competition on the horizon. Could be the Tata Group, could be something else. How does competition pan out for you?
The competition will always be there, but we have been able to get a large market share in the Android ecosystem. So pretty much all the brands which are there on Android ecosystem are our customers. And so if you look at, so all the brands. So Tata's have a play on the iOS ecosystem, the Apple ecosystem, where we are not present today. But pretty much all the brands which are there on the Android ecosystem are our customers. And Android definitely is a much larger market as compared to the Apple ecosystem market in India. Now, as part of a strategy, we are deeply investing into the components, backward integration, which is the display assembly, where we have already tied up with HKC. We're looking for partnerships on precision components, mechanicals, battery packs, so that we further add to our strength and create a mode in the business. And now the largest piece that we have now looking is to get into the display fab. So clearly, mobile is the largest trigger for our growth, and followed by telecom and IT hardware, which are also looking very promising.
Saurabh, I want you to come in on consumer electronics and appliances as well. You know, the revenue distribution from that particular segment has also come off as much as over 30% year on year. What could be the potential reasons here?
See, TV has been under a structural slowdown, I would say, because definitely the younger generation, they're not buying as much TVs as generally that was the case earlier. They're consuming more entertainment on mobiles, tablets, on the go. So clearly TV, not only in India, but globally, it's going through a structural slowdown. So what we are trying to do in TV is to get into other categories of industrial, automotive, industrial displays, automotive displays, signages, and so that is there. We're trying to do some more backward integration there. But clearly, we don't see much growth happening in TV business. As far as the home appliances business are concerned, there are two categories. One is the semi-automatic, where we are now already achieved a large market share, and we have now come back to a scenario where we are continue to achieve a single-digit kind of a growth. But our fully automatic top loader portfolio continues to have a large growth, more than 40-45% growth on a lower base, because continuously we are adding more customers there. And at some point of time, we are now looking at getting into more categories of robotic vacuum cleaners, chimneys, your hair dryers, some kitchen appliances. And also at some point of time, we may look into get into the front loading category as well. So clearly
What
that.
is the timeline for that, Saurabh? Because what you're saying is a very true sort of cyclical point, right? The demand for
Yeah.
TVs has come down and you are transitioning to other products with those facilities. But what is the timeline you see for this kind of a transition?
So my sense is you will get to see those announcements in next 6 to 15 months, I would say. So we are already working on that. We already have working with some customers on that categories. So this piece I'm absolutely sure about, that the home appliances piece will continue to show a good growth along with the mobile, telecom and IT hardware piece.
Just want to get a sense on, the kind of growth you've seen in the mobile and EMS division and scorching pace in the last 1 year. Do you see this now tapering off? Is it hit its peak, close to its peak?
No, I think so. We will, so we pretty much will do a volume of almost 30 million smartphones. Last year we were at 5.5, 6 million smartphones. So we have grown like almost 5 times this year. And I assure you that in next 2 years, we should be doing a volumes of 6 to 6.5, 60 to 65 million, because we have a large order book from all our customers. Some of the customers are looking to do exports from India, and some of the partnerships that we have announced will also start reflecting in our numbers from H2 of next financial year. So clearly in 2 years time, we expect to double these numbers, and not only double these numbers, because of the backward integration strategy, we're also looking to expand our margins. So we think that by doing all those backward integration projects, we should be able to expand our margins by at least 100, 120 bips over the next 24 to 28 odd months.
Just one point on your margins as well. With this, I think one thing that stands out is you have defended margins, but having said that, with the scorching pace of growth, margins haven't moved at all. Do you see this range being maintained, Saurabh?
No, I see the margins now from here onwards getting expanded because of our play on the backward integration in mobile. So like the partnership with on display assembly with HKC should start getting reflected in the numbers from Q2 of next financial year. And similarly, we are pursuing aggressively partnerships on precision components, mechanicals. Now, all these backward integration projects that we are planning to do in mobiles will come at a double-digit margins for us. So presently, the mobile margins are hovering between 3.5, 3.3 to 3.5%. So once they start reflecting, that the margin profile will continue to increase. See, what is happening at an overall level, the operating leverage benefit is kicking in. The designing benefits wherever possible are reflecting in better margins. But since a large part of the growth is coming in mobiles as of now, which is kind of pulling down the margins because it's a relatively low gross margin, low EBITDA margin business. But the things will start to change as we get into backward integration. So you will see that margin expansion happening in mobiles, which will have a positive impact on the overall company margins.
And when do you see that happening by, Saurabh?
So by Q2 of next financial year, you should start seeing those numbers.
Sorry.
No. Just wanted to reiterate that by Q2 of next financial year, you see an improvement of margins to what extent? What are you penciling in when you say that backward integration will boost?
Over 2 years, I expect 100 to 120 bips improvement. Okay. But from Q2, so by next financial year, yeah, it should be around 30 to 40 bips kind of an improvement, which is possible.
That's as clear as you can get. Yeah.
And Saurabh, but just to reconfirm from the last conversation that we had, was in fact when I was in your facility, you had suggested a 35% growth CAGR for revenues over the next few years. You maintain that?
Yeah, definitely. I think that should be doable. We should be, I think so, kind of order book that we have in mobiles.
Right.
From a large base this year, I think so we can grow by almost 50% next financial year.
Okay. Okay. All right, Saurabh, we'll leave it at that. Thank you so much for joining us and giving us all that clarity with respect to the business going forward.